Every single major financial bubble in modern history has basically popped exactly this way, then collapsed 78%. But the same pattern is happening behind the scenes, which caused these massive market crashes to happen. So, over the last couple of weeks, everyone's been really bullish, thinking that the crypto market pump is going to continue and that Bitcoin is going to go head straight back up to $100,000. However, I've been telling everybody on my YouTube videos for the last 2 weeks, especially, that a big dump is imminent. And the last thing you want to do is start to buy just before the market goes down. And what we've seen over the last 24 to 48 hours has been the start of that dump. Today, we're going to break down my analysis and my prediction, my price levels where I think the market is going to go and what is causing this dump. And if you got caught in the bullish hopium, it's probably a good time to hit subscribe so that you can stay up to date for when I post my videos every week to keep you up to date. Now, before we get into the data, this is for educational purposes only. I'm not a financial advisor. I'm not telling you to buy and sell. Always do your own research and never invest more money than you can afford to lose. Let's look into the data, analyze the charts, so I can give you my price prediction for where I think Bitcoin's going to go. Let's jump in. All right, guys. So first off, here you can see last week I told you guys we was currently sitting at around the $82,000 mark. And on my video, I said we're printing a bearish divergence, which is what we saw here, which means that the buying momentum is slowing down, and I expected a reversal. And you can see we got that reversal dumping about 8% where we are sitting now at around 79,000. Now, a lot of this stems on the back of what is happening within the bond market. Now, if you're new to this, a quick way to explain what the bond market is basically you're investing in the government. The government has a way where they loan money from people, countries, or even corporations. And when people stop loaning money and they sell those bonds, we have what's called a bond yield, which is the interest rate the government has to pay. That interest rate goes up. That causes normal interest rates also to potentially go up and basically causes a lot of stress on the economic system, which has led to dumps in the past. The 30-year US Treasury bond has closed at 5.14%, which is the highest closing level since the run-up to what we called the global financial crisis. And during that time, we saw a massive sell-off of a lot of stocks. The last time 30-year yields were here, the global financial system broke. Now, debt levels are dramatically higher, wars are escalating, and central banks are trapped. The next move in bonds could decide the direction of stocks, gold, crypto, and the dollar for the next decade. One of the biggest holders of US bonds is currently dumping them massively to stack gold. China's holdings just dropped from 693 billion to the lowest level since 2008. The last time we saw this move, we were standing once again on the edge of the global financial crisis. But it's not just China that's selling the bonds. And you've got to think of it like this. If countries are selling bonds, the percentage of the yield is going to get higher and higher and higher, and that causes more economic stress, which can cause a risk off market. When we look at things like crypto, they are a risk asset. That means that people like to invest in them when the market is risk off, when there is safety. But when the market is seeing stress like this, it causes a risk off environment, and people tend to sell up those assets in times like this. It can lead to markets dumping. China isn't the only one right now that's selling those bonds, it's also Japan. The Bank of Japan is about to make the largest treasury liquidation in 30 years. They are dumping also $2.8 billion worth of US treasuries. And the last time that this happened, the US stock market dumped 15%. So I bet you're sitting here thinking to yourself, Matt, I came here for crypto. Why are you talking to me about the stock market? So one really important metric that you need to take notice of is what we call the Bitcoin Pearson correlation. What we've found historically is that Bitcoin has correlated, meaning followed the stock market very, very closely. And you can see right now that Bitcoin has about a 94% correlation to the Nasdaq and to the S&P 500. So what that means is that if the S&P 500 dumps and Bitcoin has a 94% correlation, there's about a 94% chance, unless that correlation breaks, that Bitcoin is going to dump with it, and that will also bring the altcoin market down as well. If you're a trader, you'll probably know this by now, but when Bitcoin dumps 5%, it's very common to see your altcoins also dump 10%. Whatever Bitcoin does, alts often double. Now, why are Japan dumping their yields, and when is this going to stop? Japan themselves are also seeing massive 30-year bond yields, okay? So theirs are at 4.14%. The issue here is Japan are a major holder of US bonds, which is also what we spoke about earlier at 5.1%. In order for Japan to get their bond yields down, they need to sell the US treasuries and buy back their own bonds. Therefore, Japan sells those US bonds, buys back their own, it lowers the Japan bond yield, but because they're selling the US bonds, it continues to increase the percentage yield of the US bond, causing more and more stress on the economic system. Now, why is no one talking about this? And this is where you all need to pay attention because it's actually a lot more serious than what you may think it is. Japan's 30-year bond and the US 30-year bond yield are getting very close now. And now in the last 18 times, this has only happened 3 times before. The JP 30 and the US 30 shrunk and there were only 100 basis points apart. Over the next 6 months, the S&P crashed 43%. 2011, 2012, same thing happened. They were shrunk and they were 150 basis points apart. The S&P dropped almost 22%. And then in 2020, during COVID, we all know what happened there. Bitcoin dumped from like $10,000 down to around the $3,000 mark. Pandemic fear brought the 30-year Japanese yen bond and the 30-year US bond even closer. Everything had a flash crash. So why is this a bad sign? Because the rising Japanese bonds reduce the demand for US bonds. And because Japan is the biggest T-bill holder, that causes US bond yields to spike. High bond yields means more debt repayment and a risk-off environment, which eventually leads to brutal market crashes. Think of it like this, okay? Last time Japan's bond yields were up at around 3%, what actually happened was Japan lifted their interest rates. And if you have a look back in 2024, that caused what we call a cash and carry trade. And Bitcoin actually dumped about 30%, which was massive. We're seeing a time right now, which is very similar, where the Japanese bond yield is extremely high. They're going to have to lift interest rates. And the US rate is also extremely high too. So basically like a double whammy. Every single major financial bubble in modern history has basically popped exactly this way. Bond yields started rising sharply, markets ignored it, and then the bubble broke. It's happened in Japan in 1989. There was the dotcom boom in the year 2000, and China in 2007. And the same setup is appearing again globally. In Japan's bubble, government bond yields surged about 230 basis points, and their version of the S&P 500, which is called the Nikkei, later crashed more than 60%. In the dot-com bubble, we're all pretty aware of what happened there, but the US Treasury yield surged about 260 basis points into 1999 as the Fed tightened policy, basically raised interest rates and did quantitative tightening. Markets kept rallying anyway because investors believed the internet would change anything. Relate this to what we're seeing right now. The narrative back then was the internet is going to change everything. Let's continue buy, buy, buy. What are we seeing in the markets right now? AI is about to change everything. What are people continuously doing? Buying, buying, buying. But the same pattern is happening behind the scenes, which caused these massive market crashes to happen. So then, after that happened, after markets kept rallying because people thought the internet was going to be the next big thing, which it was, the NASDAQ then collapsed 78%. In 2007, China's bond yields surged again before one of the sharpest equity crashes in the country's modern history. The pattern's always the same. Easy money inflated the bubble. Higher yields eventually killed it. Now look at today. The US 30-year Treasury yield is around 5%, near the highest level before the 2008 financial crisis. Germany's 10-year yield is at the highest level since the Eurozone crisis, and UK bonds are near 2008 highs. Japan 10-year government bond yields at the highest level in almost 30 years. And all this is happening whilst AI stocks dominate the market, stock concentration is above dot-com levels, valuations remain extremely high, government debt keeps exploding, and inflation remains sticky. Can you see that this is almost looking a lot like a repeat of what has happened before in the past? The entire 2020 rally was built on the idea that interest rates would stay low. Now, one important thing that you need to take notice of, right, is usually when you see the bond yields go up, it's an indication for interest rates also going to follow suit. In order to see the crypto market go up, we want to see interest rates come down because that means that money is cheap to borrow. Heaps of people then go and prop up their businesses because they can get money for cheap, which leads to the business cycle expanding and also money flowing into stocks because when money's cheaper, people can go out and buy more things, which leads to a healthy business cycle. But when money's cheap, you also find that some of that money goes and finds its way into the stock market, into the crypto market. But when you're seeing bond yields raising, we may start to see the opposite now to take effect, which means that interest rates may start to go up. So previously, when the market was bullish, there was about 3 rate cuts that were being priced in for 2026. Right now, after we've seen the bond yield go up, we've seen inflation last week absolutely skyrocket. What we're seeing is that there's currently a 0% chance of a rate cut this year. However, in 2027, instead of getting a rate cut, we're actually at about a 70% chance for a rate hike instead of a rate cut. The US 30-year bond yield and the Japan 30-year bond yield are now only 100 basis points apart. And if we take a look at the chart, last times this happened, S&P dropped 34%, 15% and 30% respectively. So now going back to the crypto market and having a look at the charts. Last week I told you all there was a very high chance that we were going to reject at this level. What scared me the most is that if you can see here, this red line, this is the 200-week moving average, and we also have another moving average here for the 200 on the daily. The market came up, rejected it not once, not twice, but three times before then toppling over and dumping for about a 7 to 8% dump to where we're sitting now at about $76,800. What we're seeing is that the market is currently now oversold. And when we're seeing it oversold, what we usually can expect is some shorter term momentum towards the upside. Now, if I'm looking at the chart over the weekend, we saw a dump which caused a CME gap to form. And that CME gap is formed at approximately 79,000 to about $78,400. We can see that really clearly here on the CME chart where there's a gap perfectly in the middle of the chart. Now, gaps in most cases do get filled. I think there was a statistic where like 32 out of like 33 of them have been filled. So at some point, there is a high probability that the price will come up here to fill this gap. Now, I'm expecting something like this could happen within the next 7 days. And what I'm going to do is I'm going to drop all my charts into Empire, which is the social media platform for crypto traders that I own. If you're a crypto trader, click the link in the description below. Come and jump in. It's free. We hand out analysis in there as well as giving you a community to discuss your trades and basically all the news that happens in there so that you don't get left behind. So click on that link in the description. But I'm estimating that we're going to see price come up to around this level before rejecting and continuing down. Price has now fallen and reclaimed back into this zone. This is called a bearish flag. And if we have a look here, it played out once before where price dumped, put in this bearish flag, and then continued to dump. We're now seeing price put in another bear flag, rejections off those key levels, and now I'm expecting further downside. So my target right now is sitting at around $54,000 to $48,000. I do think that we will come up to retest at some point, but unless we claim above these levels where the 200 EMA and the 200 daily SMA cross, I want to see price come above and then reclaim that as a bullish retest before continuing up. I still see right now there's a high probability that we're going to continue down for a little bit longer. Especially if we have a look on the news headlines, we can see that the war in Iran is also escalating. We can see that there's also been a very high chance that when a new Fed chair gets elected, we see a sell off for the next couple of months. And also, Michael Saylor has decided that he's also not going to be buying over the next 3 weeks. So, if Michael Saylor isn't buying, where's the buying pressure coming from? So, I still think we have a little bit more to come down before we turn around and say that we're bullish once again. But I'm going to be monitoring this week by week to keep you guys up to date. So make sure that you've hit the subscribe button, hit like if you enjoyed this analysis so that I can give you guys more. And I'm going to see you all next week. So bye for now and make sure you stay safe out there. Always do your own research and never trade more than you can afford to lose.